Broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to Option Pit's webinar for this evening. We're talking tonight about trading breakouts with options. My name is Keith Harwood. I am the founder of Trade Academy, working with Option Pit tonight to give you guys this special presentation. So I like to call this leveraging stock breakouts because that's what we're really doing using options, is adding leverage. We're going to talk tonight about trading breakouts with low implied volatility. These are some interesting ways, I think, to trade options from the long side, where I think a lot of people are more familiar with trading options from the short side as an income producer. To do the normal disclosures, all services and content provided are for educational and information purposes only and are not intended as legal or financial advice. All of this information is just that. It's for educational and informational purposes. Do not consider this to be a trade recommendation in any way, shape, or form. Neither Option Pit nor Trade Academy are investment advisors. You should consult with a financial professional before entering into any transaction. Options have risk. At the end of the day, you guys need to do your own due diligence before entering any trades. So with that, why don't we get into the actual meat of the presentation here. I am Keith Harwood. I'd like to introduce myself. I have over 10 years trading options. I started at the same firm as Mark Sebastian. He was actually one of my trainers when I was coming up through the training program. Learned a lot from him, obviously learned a lot from the training program, and I took that knowledge to be a market maker on the floor of the CBOE, an off-floor option market maker, ICE, PHLX, AMEX, basically traded every exchange with the equities and ETFs. Eventually actually moved over to the CME side. I traded options on European fixed income, and I traded options on gold and silver during the sort of introduction of quantitative easing in 2011 or whatever that was. God, it's been a long time. So yes, I was on the floor. I was a market maker. I've run books for equities, ETFs, fixed income, commodities. Went to a CTA, traded their precious metals book, traded gold, silver, traded some copper, some platinum. And then to kind of add a little bit extra to them, I handled a lot of their derivative strategies. So they would come up with a fundamental bias in the commodity, and I would tell them how to express that view best with the options, particularly given where volatility was at the time, where implied volatility was, where their price targets were, how we thought that this stuff could play out. And so I had a lot of experience now trading directionally using options and using that background in volatility arbitrage and relative value that I started off with. Came to learn that technicals really are as strong as anything these days in the markets. Algorithmic trading, computerized trading drives a lot of the money in the markets. And given that, I felt that there was a little bit more money to be made and a little bit more interest to be made in trading options in equities where there's a large universe, and then bringing some of that back to the people and helping explain to people how to use options for their own trading. And that's what I'm doing now. I started Trade Academy to help people learn how to trade better, trade smarter, focus on trade construction. I trade my own book there as well, and I educate on options and basically using options to leverage your view, because I think there's a lot of power in leveraging your view with options, particularly with as low as volatility is right now. If you can find that sweet spot where there's a stock that's about to really move, you can make a lot of money using the options space. So let's talk about one specific setup in that. We're going to talk about the trade that I'm particularly intrigued by. And that's talking about trades with low implied volatility and a good potential for a breakout. I want to explain to you guys why this trade setup works. Give you some guidelines for how to start out with constructing the trade once you know how the trade setup works. Obviously every trade has its own little nuance, but I think that this gives you a little bit of a starting point. And then we're going to go through a few trades that I see setting up today that fit this trade setup so that you guys can see it in action, how I'm putting these trades together, and how we can leverage the markets as they stand. So we got a lot going for today. It's going to be pretty exciting. And let's dig right into the trade setup. There are two key pieces for this trade setup. You want a stock very close to a 52-week high or a 52-week low, and you want implied volatility very close to a 52-week low. So you want the stock at that extreme price point, and you want volatility at the extreme low point. When volatility is at an extreme low point, that's where we get our leverage. So if stock is close to a 52-week high, and we buy some calls, then gamma and delta are our friends. We're expecting an increase in realized volatility when the stock breaks out, and obviously we're going to be long delta. So we're going to be long delta, expecting to increase our delta position due to the gamma of the options, and that's where we really make our money on stock breaking out to the upside when we're long a call. If you're close to a 52-week low, then you've actually got the third benefit of vega. So we're expecting an increase in realized volatility on that breakdown. We're expecting our delta to work for us if we're long a put. And we have that third benefit of usually, and this is not always, but usually we expect implied volatility to increase on a break. And that's because insurance tends to increase on a break. That's why we see the normal equity skew in markets. When the markets go lower, it tends to incite panic and fear. That results in people buying more options, and that increases the implied volatility of the market. So that's really what we're looking for right here. We're looking for a stock very close to that high or that low, and we want implied volatility very, very cheap so that we can get our leverage very cheap. So why do I think this trade setup works? So the stock, again, we want close to that 52-week high or low and the implied vol at the low. The stock being close to a 52-week high or low prepares us for a breakout where traders on the wrong side will be forced to exit. A lot of you have probably heard of short squeezes. We've seen a lot of them in the market this week, actually, particularly in small dollar, low dollar biotech stocks. If you want to see some examples for yourself, you can pull up a chart of ECYT or MNKD. Those two really got whipped higher this week, and a lot of people claim that the fundamentals haven't changed. And yet these short squeezes occurred. They're not actually at a 52-week high. They're at a little bit of a different point, but that's the kind of thing we're looking for. We see a stock start to rally, and the shorts are losing. If you're at a 52-week high, everybody that has sold this stock over the last year has lost money going short. Everybody that is long is making money. There's a natural flow to buy stocks traditionally. That's the passive investment flow. That tends to push stocks towards new highs. So you have a natural buyer of stocks, and that's just the standard passive investor. And you have the shorts needing to cover and the longs having zero interest in selling. There is no price point that they are particularly inclined to sell at this point. Some people have fundamental biases on where they think the stock should go, and they may sell at that point, but there's nothing really in the way. There's no resistance on when you're getting to that 52-week high. When you're getting to a 52-week low, the opposite is true. Everybody that has bought this year is losing money. Everybody that is short this year is making money. Computers right now enter both long and short positions for obvious reasons. They want to have some sort of risk parity trade or some sort of risk off. They can't only be long. They continue to push these stocks lower because the ones that they're pushing lower are making money. The only way to stop that stock from going any lower is somebody has to go out there and quote unquote catch the falling knife. When you see that falling knife, it usually results in lower prices, and that's always dangerous. And that's why a lot of people teach that philosophy of you never want to catch a falling knife. And that's what continues to allow these stocks to drop further because everybody just wants to get out of the way. There's no natural buying point. Some people may decide to put in a little bit of a bias in investment, but it's not like that's going to turn the market around until somebody with a lot of money decides it's time to either exit their short or initiate a new long because the stock is just way too low. And when that happens, the stock will start to turn around and we're not going to want to be short anymore. The thing with the implied volatility being very close to a 52-week low is that we get a lot of cheap leverage and very well-defined risk, and we get it for cheap. So we're trying to find these options on sale when they shouldn't be on sale. When the stock is in the middle of a range and it's basically just following a random walk, and there's an equal number of buyers and sellers, and implied volatility is fair or even low, there's no guarantee that that's going to play out. But when you get a breakout to the upside or a breakdown to the downside, those cheap options can really pay you fast. If we hit those stops and go higher from a 52-week high, the market can move quickly and in an illiquid manner. That's really good for our long calls. If the stock fades from that extreme high instead, the exact opposite can happen, and it can fall fast, because a lot of times when you get towards those 52-week highs and it starts to roll over, a lot of people get out at once. And so we need that defined risk characteristic. Now, generally speaking, when I'm looking for these trades, and what I'm going to talk about today is how to play it for the breakout, not for the retracement, not for that exit event. The exit event can be just as profitable if you can catch it right, but it's easier to catch the up move and continuing higher than to try to catch a turn. Catching a turn is kind of calling a top. It's a little bit more market timing, but you know that a stock is strong when it continues higher. And it's easier to stay long with the trend than to try to call a turn of a trend. Calling a turn of a trend is a very difficult game. Staying with the trend is what you get to do when you're buying 52-week highs and using that leverage and defined risk that we get as a benefit from cheap options. One of the things I want to talk about here is what drives this volatility to be so low as well. So it's very easy to explain into a rally. When a stock is at a 52-week high and rallying, there's a strategy that a lot of people use in bullish stocks, and that is that they sell out of the money calls as a source of income against their long stock position. So if a stock's trading $50, they might sell the $51 call. As you rally, they continue to sell $51 calls. This is a buy rate. This pushes vol lower. And generally speaking, when the stock's rising, we know that there's usually a lot of panic buying. The reason I like this is because it can incite panic buying as people create a new 52-week high and shorts have to get out. That's one of the exciting things about this. And especially when volatility is low, if it's because somebody's been selling a lot of calls and we go through their strike, now they're in trouble because they have to make a choice. They either abandon their stock position by allowing themselves to get assigned on their short call that goes far in the money, or they have to figure out a way to get out of that short call position so that they can maintain their long delta. Those are what makes this a little bit exciting. If they have to buy back the calls, that's actually going to increase volatility. A lot of times they end up just buying the stock more and selling further out calls, later on, or they roll their short call out. But either way, they're buying delta as we rally because they have to get back in the stock. The other reason that we see volatility at these lows is because the market on the whole is at lows and nobody cares about the stock. There's just not a lot of trading volume, not a lot of open interest, so it's just trading off of its correlations to the S&P volatility. S&P volatility, for those of you that didn't catch it, closed at an all-time low today. The VIX closed at the lowest level since 1993 when they first started watching it. So volatility on the whole is very low right now. There's a lot of stocks at 52-week highs right now. Some of them are have incredibly depressed volatility because people are selling calls against their position, and some of them have incredibly low volatility because they're just trading off of their correlation to the VIX. The volatility of that stock is trading off correlation to the VIX. The more unique scenario is these stocks that are trading close to a 52-week low with volatility low. First off, you look at what's going on in the market today, there are very few stocks trading near a 52-week low. You know these stocks are garbage because if they can't rally when everybody's buying everything, it means there's no reason for these stocks to go higher. Do not buy them until the only people that are buying them are shorts getting squeezed out of their position. But what causes that volatility to be so low in these stocks is what I mentioned before, where nobody cares. So they're just trading off of their correlated volatility to the S&P. That's not a bad thing for us. It just means that people haven't recognized this opportunity where volatility is very close and very low, and maybe the stock's going to go bankrupt, or maybe it's just going to have a really bad day, or maybe there's some long positions out there that aren't worried about buying insurance because how much lower can the stock go, quote unquote. Like, that's an irrational view, but it sometimes plays out. There are two other ways that these stocks tend to get to 52-week lows. Sometimes the long of this stock, as it's breaking, is selling out of the money calls because he's abandoning his position. We saw this happen in a few of the oil names as they broke. There were a few people that had been long calls in oil names, and so they were selling calls, selling out their position as we broke. That meant that the implied volatility did not increase into the break. The other scenario is where You've got somebody out there, a fundamental trader, fundamental investor that says, if a stock goes any lower, I don't care, I will buy it. And so what do? They sell out of the money puts. This is Bill Ackman, one of his favorite things to do. He did it in Valiant. It didn't work out so well for him. He's done it in Mondelez. He's done it in Chipotle. He did it in ADP. Part of the reason he sells these out of the money puts, and he usually uses a little bit longer term puts, like Jan of 18 or Jan of 19 even, is because he thinks fundamentally this stock is too cheap already and it shouldn't go any lower. And so he continues to sell puts. But the problem is eventually he may lose the game. He may find out he was wrong. I saw it a number of times. I've seen it a number of times where somebody says in a $50 stock they want to sell the 45 put because they would happily own the stock below 45. Well, what oftentimes happens is that in the act of getting to $45, some new news came out that drove us below 45, and they no longer want to be long the stock at 45 or lower. So what do they have to do? They have to cover their puts. They have to get out of their position entirely. They are hitting stops and they are creating that falling knife scenario. That's excellent for us because not only are they selling out their stock position, they are buying back their puts. So they are driving the stock lower against themselves. They are driving volatility higher against themselves and just panic exiting their position. That is why when a stock is close to a 52-week low and there is a large amount of short puts out there, and those puts are just getting in the money, they can get very exciting very fast. That's the home run scenario right now. I don't see a lot of that out there, but that'll change as the market start sort of changes around what it's doing from where it is right now, where it's just, it seems like every stock is at a 52-week high. In terms of actually constructing the trade, there's a general guideline for strike selection. You're looking for a move of about 1 standard deviation in the direction of the breakout. So a standard deviation, as you guys may remember from statistics, is a move that should happen. You should have the stock either up or down 1 standard deviation or less, 68% of the time, I believe it is. But when we have the trend right, then we have a little bit of an improved probability of seeing that move up a full standard deviation. So 32% of the time, the move is greater than a standard deviation. It's very rare that you get a move greater than 2 standard deviations. So we don't want to target a move of 2 standard deviations. You want to look for a move of about a standard deviation because that should happen roughly a third of the time. So if you got the direction right, you say up is the right move. That means a third of the time you will move 1 standard deviation or more. 2/3 of the time you will move 1 standard deviation or less. If you want to improve your odds, you look for a little bit less than a standard deviation move in the direction of your breakout. But I like a full standard deviation because we said we're looking for an increase in realized volatility when the breakout occurs. You don't buy the option that is 1 standard deviation out of the money, and that's crucial. You want to optimize your strike to maximize profit if the stock moves a full standard deviation. So your strike has to be in the money after the move is complete. You get long a 1 standard deviation out of the money call. So let's give you an example on this. If we're expecting a stock to move, if the 1 standard deviation move is $3 in a $50 stock, you don't want to buy the $53 call because at expiration, it's out the money. It's worthless. If you buy a 51.5 call for the right price and it's worth $1.50 after the move is complete, you've got a chance to make some money there. You need to have some sort of intrinsic value when this move is complete. So generally speaking, again, you want to target an option that is less than a standard deviation out of the money. Yes, I will. I'll clarify that. More time to expiration. I add more time to expiration when I'm trading a put than when I'm trading a call. So traditionally, I will look for a call that is 2 to 3 weeks, anywhere between 1 and 3 weeks really out of the money or away from expiration. 3 weeks is kind of a long trade on the call side right now because you're trying to get some gamma. If I'm trading a stock that's on lows, I want a little more vega in my position. So on that breakdown, I get that implied volatility increase. Into a rally, I don't normally see that implied volatility increase. I tend to see realized volatility increase. So I don't need to have a vega intense option. I need a gamma intense option on the call side. On the put side, I'm happy with a balance of gamma and vega. So I tend to look closer to a month out on the put side and a little bit shorter, about half that time, 1 to 3 weeks on the call side. And yes, I have two scenarios, either a stock at a 52-week high or a 52-week low. And that 52-week high is where I'm going to be 1 to 3 weeks to expiration. On the put side, it's closer to a month to expiration. We calculate our standard deviations based upon that time to expiration. But just as a rough guideline, what we're looking at really for what we want to play is a 30 delta put. That's the easiest way for us to start off as a guideline, is look at a 30 delta put. That should be well on the money when the one standard deviation move occurs, if and when that one standard deviation move occurs. So I think that's a lot of information, but the easiest way to see this is to actually look at some trades that I think are setting up today and see what I'm looking at, how I would trade them, theoretically, of course, for educational and informational purposes. But I think these are interesting setups. They've got good probability of paying out, and we may even see some really volatile moves, particularly on the upside. I think you could get some interesting stuff the way that everybody right now seems to be afraid to sell anything. Market is in extreme frothy conditions, and yet I think there are still some stocks that continue higher. And then I like, we got to look at the put side, because these are the stocks that are performing poorly now in spite of this froth. I mean, these things should be destroyed if we get a market to break it all. So let's go straight over to them on our live ball. And some of you guys probably use live ball. Many of you have probably seen these before from Mark's previous presentations. Yes, Jason, I'll look at those at the end for you. And I already know KMX is yes. I'll have to look at ACN, but KMX is one that I considered for this. And Mike, I'm going to be looking at these as simple calls and puts for tonight, but there are spreads and calendars that I think you can use to leverage as well. And I'll talk a little bit about that at the very end here. But the first one I want to look at today is CBX, Chevron, oil company. A lot of these have done really well. You saw this nice long uptrend here that slowed down really on September 25th. So for the last 2 weeks, we've been in this consolidation here. You can see we've kind of been trading in this little box here between about 116.5 and 118.5. And look what we did today. We made a new 52-week high today. Part of this is because a lot of stocks made new 52-week highs today. I can just show you though, XLE closed above the 200-day moving average as well. So I think we're a little bit more excited about the oil names. We'll go back to Chevron. So that move today gets me a little bit excited. What gets me more excited is, I know, and many of you may know this already, but oil name volatility is at very low levels. There's been a little bit of a pickup for Chevron in the 30-day options. That's because of their earnings being on October 27th. So right now we're looking at a technical trade. Our trade is going to be something that expires before October 27th, because I don't need to have an earnings event drive my move higher. My cause of my drive higher is breaching technical levels, shorts needing to get out, longs wanting to get in. So we go straight over to the options here and we look at the implied volatility levels, and there was a bit of a pickup today in implied volatility, unfortunately, but I think it's still cheap on the front. You can see one thing that's important here. Realized volatility has been very low the last couple of days. That was the nature of trading in this tight range between 116.5 and 118.5. But again, I'm expecting this realized volatility to come back up towards a more normal amount, 14, 15%. If I look at a year, 14-ish percent, 15% is a really reasonable level, especially if you get into a breakout mode. It could go 16 or even 18% for a short time period. So when I look at the October 20th calls, we're going to give ourselves 2 full weeks. October 13th is a little bit cheaper, but I do like to give myself that full 2 weeks, especially when the market's as high as it is right now. You could see a little bit of consolidation need for tomorrow, a Friday. Then you get the whole weekend effect. I want to get us out to October 20th to be a little bit safer here. And our 30 delta call is the 120 call. Now, a couple things of note here. There's a little bit of open interest on here. Not huge, but there's some there. Number 2, there's some buyers today on calls. Particularly near the close here, somebody actually came up with the same idea. They were buying these October 120 calls. They paid 62 up to 65 cents. They bought about 1,000 of these. So they're looking for further upside too. That helps convinced me that my idea looks good. There was also a buyer of these here, 121s, 36 cents. So there's some decent buying here on the upside. I don't want to go all the way to the 121s. That's a little bit of a lower probability. Over the course of 2 weeks, we would normally expect to see a move for one standard deviation to 121 or 121 and a half. That's not great for the 121s. The 120 is much better. Now, if it has a bigger move and it goes to 122 or 123, we would have gotten more leverage out of being long the 121s. That's certainly true. But I'm going to get a little more probability out of the 120s. And if we go to 122 or 123, I'm still going to make a lot of money being long these at 65 cents. So you can see here, it's a 30 delta option. Volatility is low at the front. It's a 2 week out, so right in that sweet spot for calls. It's very gamma focused. It's all about getting these guys right when we're in the breakout. And the problem that we just have to make sure we don't see on tomorrow or in the next couple of days is we don't want to move back below the September 25th high, 118.33. As long as we're still sitting here above 118.33 and continuing for higher moves, we can maybe repeat something that we had here where we were trending higher a month ago. And you can see that in the course of a week, from September 5th, when we first crossed the 200-day moving average, to September 12th, the rally was $3. $3 from here puts you to 121 and a half and does really well for these 120 calls. So that's the benefit of these really cheap calls here. If the stock continues higher, these things could easily be worth $1.50 or $2. If we break, you exit these before they're worth nothing, hopefully around 30 cents. Volatility probably picks up into a break anyway, and you actually save yourself some money. And your R&R here is exceptional at that point if you're risking, say, 35 to make potentially $1.35. And you think probability is on your side, as I do because of the breakout. So that's a really exciting setup for me. That's Chevron. It's breaking out now. That's great. Let's do another one, similar idea, but in a different sector, and that's VMware. The tech stock. Tech was lagging a little bit, but it seems to be catching up. This looks a little bit like the chart of the Qs, honestly. It had stayed here again in this somewhat tight range. Previous 52-week high was 112. Today's high was 111.89. So it's not quite to that breakout yet, but on a move above 112, I think we're easily going to see that move to 114 or higher. I'll come back to you on that in just a moment, Jason. Volatility in VMware is down in the dumps, 18%. It doesn't get lower than that, really. Look at a year out. It sometimes touches 18%. It just doesn't really go any lower. If we get the breakout, realized volatility, in the 20 to 24% range, not at all out of reason. So we're looking for this breakout. And again, you can look at this for a year. You can see that this has already had a good run. There's a lot of fear that this could drop if we're wrong, if this was the market top. So I don't want to have undefined risk here for that reason as well. But I also like having this leverage for that upside move. And where I see it, it's October 20th again. You could go out to the October 27th if you'd like. Get a little bit more time. That's on the full 3 weeks out of my 1 to 3 weeks. But that falls closer to 19%. If I go to October 20th, I can get calls at 18. If I went a further standard deviation out, the 20 delta calls, you can get it under 18. But I'm going to hit my sweet spot here. The 114 calls, I think you can get these for 70, maybe 75. You definitely can get them for 75. You can see that these are a little bit higher. They should be offered at 75. 70 is a chance, maybe. If you wait for the breakout, you may have to pay up to 80. But our one standard deviation move is $4.50. You can get to 116. So this is, if you're risking, again, you're originally paying 70. If you assume that you're going to risk every penny of it, you're risking 70 to make $1.30, $1.40. And if you see a failed breakout, as I mentioned on CVX, it was a move back below the previous 52-week high. We're looking at different ways to try to calculate what that failed breakout looks like. If we get above 112 and then fade back below, that's a bad sign. It's a failed breakout. Well, right now we're looking really good to set up for this breakout. And I think we're going to get it tomorrow. I think that this is going to continue higher. And if it doesn't, and we get back here towards the middle of this congestion range, 110, 111, you probably exit your calls because they're short dated. So you need that move now. And you wait for it to set up again. You may end up selling these out at 50 cents, waiting a week, waiting 2 weeks, and saying, God, thank God I sold these out at 50 or 40 or 30 cents. You got to preserve capital when the breakout fails, because then it doesn't fit the trade anymore. But that's VMware. That's, again, the call side. Again, much more gamma focused by being 2 weeks out of the money, or 2 weeks to expiration with October 20th. The put side gets a little more interesting to me, and in particular, I really like two stocks. Viacom. If I look at this chart and I am trying to put some sort of fundamental value on Viacom, I might say, you know what, the entire market's rallying. Viacom is dirt cheap. This is where I can get some leverage. And this is where you're buying a falling knife. You look at a year. Stock has dropped from highs in March of close to 47 bucks all the way down to 28. This is in the dumps, and it's going lower. And you can see today, on a very strong day for the market, Viacom was down 3%. That's a really bad day, especially when the market is settling across the board at 52-week highs, and even bad sectors like retail and some of these other ones that people have been hating are starting to rally here. So Viacom is one of the worst performing stocks out there right now. The 52-week low is 26.65, so we're about 2.5% away from that level. This is about as close as you can get to a 52-week low right now in this market, because there are so few stocks near them. This is a very rare occurrence, but you can see really below 27, there's not a lot of trade action that happened below 27 bucks. But we got to do volatility. Volatility wise, you can see this is very cheap. It doesn't get much lower than 28%. If I go out a year, there was some trading down here at 24%. I don't expect that to occur when we're trading at lows. This is the level of volatility when we were trading at those highs, $46 levels, right? $42, $43, $44. Since we've been lower, it's usually been closer to 35, 36%. But since we've been consolidating for a little bit, it's down to 28. I'm looking for a break below 27 to really get this thing started, but we're 30 cents away, so this is on my radar as a result. So I'm looking for this move below 27. You can see that that would only leave one day, the actual 52-week low, as your final quote-unquote support level. I don't see a lot of support here, though. But in order to play that, I want, like I mentioned, a little bit more time to expiration. So even though October 20th volatility is the cheapest volatility on the board, it's 28%. That's for an at the money option. If I wanted to go down to a 30 delta option, first off, it doesn't really exist. I could either do a 40 or a 20. I'm around 30% on my volatility there. If I go back to November 3rd, this gives me a full month. It adds some vega to it, and we get the entire month of October. So we get 4 weeks. We got a lot of time for our break to happen. And our 30 delta put is really this 26 put, 31%. You can see that there's a little bit again of a vol bid to this. They should probably really be offered at 45 to line up with the rest of the skew here. These being 30.3%, these being 30.2%. So I think you can buy these for 40 to 45 cents. And that's where you get a little bit of excitement here, because this is a 26 put. So remember, our 52-week low is 26.5, or a little bit above 26.5. So as you get through 27 and approach that 26.65 level, that's where you start getting that potential acceleration. And you want an option that's a little bit out of the money when you break that 52-week low still, and really can accelerate, because the standard deviation move all the way out to November 3rd actually would be about $2.5. That puts us down to 25 or a little lower. Okay. And if you get that accelerated break, and we will get some sort of break in the overall market, I imagine, in the next month. And this could be one of those stocks that really goes down far in that process, because it's got zero buyers right now. It has no buyers when the market's going up. What makes you think that there's going to be a buyer when the stock goes down, when the market gives a pullback of any sort in the next month? So this is a really exciting setup then. Right now, because the market is so bid, I'd be getting a little bit early here by getting into these at 45 cents. But because the way the market is where it is, and the fact that it's overall so overbought, quote unquote, doesn't mean the market has to fall. It just means it has to consolidate or get a little bit of a pullback to me before it accelerates higher, or it has to have news to push it higher. It has to have something that pushes it higher when it's that much of the market. So this could be a way to get in a little bit early before this breaks the 52-week low. And that's what I'm going to be looking at tomorrow, probably, is looking at these November 23rd, 26 puts. I think they're pretty darn exciting, given that there's not a lot of short stocks that are justifying a short right now being close to those 52-week lows, especially with volatility cheap. There are a couple of other names near 52-week lows, but their volatility is very high because people are panic buying puts. Nobody's panic buying puts in Viacom right now. That makes it more exciting for me. Finally, VIP Shop, whatever you want to call it, Holdings. It's a Chinese company. It's an online discount retailer for brands in China. So it's a retail name. Retail has gotten a bounce. This got a bounce into the middle of September to $10, and then people just realized this stock's terrible. So it's at a 52-week low today. The low was 851, close was 853. If you looked at an intraday chart, that selling actually started to accelerate into the close. So somebody right now is pushing this stock lower. I expect it to continue lower, especially as you saw selling into the close when the market was continuing higher. So there's something going on here. I don't know what it is. I don't care what it is, honestly. I just want to see this stock continue lower, and I want to get into some puts before it goes. If I look at the volatility, it's not as cheap. This is about one of those points where, yes, 45% is low. It's mid to low. It can get down to 40, a little lower than 40. I don't expect it to get below 40% though, given that we're at 52-week lows. This would happen if we got a bounce back. You go out a full year though, really we're kind of in the middle of the range. But for stocks near 52-week lows, this is about as cheap as the volatility gets right now. And realized volatility has been, mid 40s when it's been moving. So if this starts moving again, we should see that volatility around that 45 level again. If I go to the options, ideally, you look at the at-the-money volatility and you see, first off, vol was down today. Guess what? There wasn't that much trading. So I scroll down here and I see very little volume. It was a 200 lot in Jan of 18, 250 lot in Feb of 18. That's about it. So why'd volatility drop today? Probably just had to do with correlations. Probably had to do with the fact that volatility spiked unnecessarily 2 days ago. Now there's no more buyers following up. So now it comes back down. That's fine. That gives me my opportunity. I'm going to go back to October 27th, get a little bit more time. October 20th is cheaper. October 27th is very good. You could even go to November 3rd again. For those 30 delta puts, that's 45% volatility. October 27th is 44%. I need to get these mid-market. So I would need to buy these for 15 cents. You can't pay up to 20. I'm paying 50 vol if I pay 20. So yes, I may be right on the direction of the move. But if I'm paying 20, I'm paying a large, and now I'm not getting cheap volatility anymore. So that's the difficulty with this name. Same idea here. If I had to pay 25, I'm paying 50% volatility. You can see that as I change the volatility here, the Theo updates to basically the ask there. So you need to get these puts mid-market in order to get in. That's the unfortunate nature of a stock like this where it's a little bit less liquid. There are ways around it with some more complex structures, calendars, diagonals, and things that you can get in for a little bit cheaper when volatility or when the markets are a little wider. That's not something I'm going to go over here today, but I think that if you can get these November 3rd 8 puts for 20 cents or these October 27th 8 puts for 15 cents, you're going to be in a pretty good position there. Implied volatility, 45%. We're expecting that realized volatility to be around 45%. That would mean that in the course of 3 weeks out to October 27th, I'd expect a move of 10 to 12%. That gets you down below 8. Let's say if it's 12%, that gets you down towards 7.5. If it's 10%, it gets you down to about 770. Either way, you're going to be making some good money if you're along the 8s and you get a full standard deviation move. Again, given what we're seeing here with the sellers coming into the end of the day, pushing it a little bit lower, I wouldn't be surprised to see that accelerated move happen a little bit further and faster and volatility to pick up. So I see a lot of reasons that I actually like this name a lot. It's just liquidity is going to be my only concern. I got to hope that I can get hit on a mid-market bid here, trying to say that, like I said, maybe I'll work for the 20s in November 3rd just to see if I can get a little bit of luck. But there's not a lot of names near 52-week lows, and this is one of the few that I think you can really leverage, especially since it closed basically at 52-week lows and is breaking down today. So that's really our major examples for today. Jason, you mentioned a couple of potential breakouts, ACN and CarMax. So CarMax was actually a pretty good one, another one on the breakout side. You can see that I didn't really like the action today with the dip, and we're not making higher highs with higher lows anymore. You know, the action on the third was really nice, a higher high and a higher low. We had a lower high and a lower low, again, a lower high and a lower low. It's a little bit concerning. If tomorrow we make a higher high and a higher low and start driving back towards that 77.5 level, that gets me more excited. Volatility is just dirt cheap. So there's a benefit there. This has got some really dirt cheap volatility. But given the last 2 days with a lower high and a lower low, that's a little bit of a flag for maybe that trend up ending. And we need to have that trend up continue in order to benefit from our gamma. ACN, same kind of idea, had a little bit of a pullback, had decent earnings, but now it's starting to come back up here. We're not near the 52-week high. We're not quite close enough to say that we're going to look for a breakout, but we are looking like we're going to retest that high. You got the inside day, and now you have a breakout from this sort of downtrend here, but it's not the 52-week high kind of breakout. It's just a little bit of a downtrend. You can see a little bit of a wedge forming there that we've broken out of. I'd like to see for this type of setup a move above 138.5, really, get up towards here to really justify the breakout. When you look at volatility, it's also dirt cheap. So just like the rest of the market, that's the one benefit here. And actually realize volatility has been a little bit higher. So there's something there. I just think it's a little early to call this a breakout yet, under my definition. Mike, in what conditions would you use a more complex option structure like calendars, diagonals, etc.? There are a number of reasons you want to use calendars, diagonals, etc. Calendars usually aren't as attractive because they're short gamma if you're long the back and short the front. And with volatility overall this low, I'm not necessarily looking to sell volatility on these trades. Diagonals can be a little bit more interesting where you sell a 2 standard deviation out of the money option or something. I'll get into that actually a little bit more in the bigger presentation that we're going to do next week. So why don't I actually just jump back over here to the slides and I'll introduce that now. We're going to do a masterclass October 14th, so next Saturday at 9 a.m. Eastern. I'm going to do 3 hours long. It's going to be a lot more in depth. We're going to talk about trades to avoid. We're going to talk more through reasons you avoid some specific trades, even when they look like maybe they're trying to break out. We're going to talk about how to manage those winners and losers. We talked a little bit about cutting losses. Didn't talk necessarily about when to exit your winner. There are some nuanced ways to figure out when you want to exit your winner. A lot of it has to do with momentum, because you need momentum when you're long gamma here. I want to talk about trading breakouts with option spreads. That will cover diagonals, verticals, etc., where you get a little bit of an edge, a little bit more of an edge trading a diagonal, particularly on the upside. And that can be very interesting and make the trade a little bit cheaper, but actually add a little bit more leverage your way. So it's really it's a fun way to trade some of these breakouts, particularly on the upside when you've got the right setup. I'm going to talk about market correlations. They are very important. And we're gonna talk about why these correlations matter, and we're gonna be explaining a little bit of why you need to watch them, interpret them, and what you need to do there. And then I'm going to talk about breakout signals that are not trading at 52-week highs or lows, so different kind of setups. And that'll be, I think, another way to really help you guys understand how to leverage some of these things. And those, we talked a little bit. I mentioned at the beginning some of these biotech stocks that are breaking out to the upside. They're not breaking out to 52-week highs. They're just breaking out of the downtrend. So we got to figure out a way to identify those before they happen, and then how to leverage them with options. And that can be a very exciting play to go. That's where you get your short squeezes. And you get your long liquidations and other things like that. And those are really, really interesting ways to leverage the low volatility environment that we're seeing right now. I'm going to do the class for $147, which is, I think, on the cheap side for the normal master class here. Or, you got to think about the money here. You sign up for the Breakout Bulletin. which is something that Mark and I have been working on together as a collaboration. It's going to have actionable option trade ideas with technical setups, and will pair with options to generate explosive return profiles. I'm going to be sending these out frequently, along with a weekly review of new trading setups that you want to be watching. We're going to do more instruction on how to pick the best options to buy. And that's $97 a month. But if you sign up before Tuesday when it launches, you get it for $47 a month for at least the first 6 months, and you'll get access to that October 14th masterclass for free. So that'll get included. Instead of paying $147, you get it for $47 per month. It's a no-brainer to me to sign up for the bulletin, get all the extra stuff, and then you get to attend the masterclass as well as a benefit for that. So that's what we're looking at doing right here for you guys. I think it's going to be a really fun way to continue to expand upon what we talked about tonight and find a lot more interesting and exciting trade setups.
Yeah, I agree. So guys, just
Mark, are you?
Yeah, can you hear me? So
Yes, I can hear you now.
yeah, so yeah, this is a steal. I've known Keith for a long time. He knows what he's doing. The class on its own is worth more than the 147. The fact that you can get it for $47 is ridiculous. And so I think everybody should sign up for this. And you're going to be a happy camper. He's been coming on once a week in our Oshpit Live trading room, and people have been very pleased with what he's been able to produce. So in terms of trade ideas and things that he's watching, things along those lines. So again, you go to, Keith has the link to the Breakout Bulletin this time.
I do.
He's going to drop it in there, and you can get yourself signed up. It's going to be, and that'll also be where the replay is. So if you want to see the replay of this, then it'll be in that on that Breakout Bulletin sign up. So there's all the more reason to go and check it out.
I put the link to the Breakout Bulletin sign up in the chat there for everybody. We'll post the replay in there, as Mark said as well, so you guys can do that. And Rocky, I use a 30 delta not to gauge just 1 standard deviation out of the money. I use a 30 delta option as sort of a rough gauge of the optimal strike for getting a 1 standard deviation move. So that way you get if you get a 1 standard deviation move, the 30 delta option tends to be one of the best returns there that you get there. Howie had a question for you. Thank you, Rocky.
I'm not sure which trade. I think he was talking about those little bull calendars we're doing. Those worked out pretty well. It just I don't want to steal Keith's thunder. Maybe I'll do something like that on my next webinar, or you can email me specifically and we can set up a time to talk. Yeah. But for the meantime, this is worth doing.
Yeah.
All right.
So are there any other questions here before we wrap up? I don't want to leave anybody. Mike, you had a question for Mark here.
Oh, what level of option pit membership would include access to your October 14th webinar? I believe just sign up for this Breakout Bulletin and you'll get that access.
Right. I mean, you could sign up for it independently.
If you buy one of our more expensive packages, obviously I'll comp the webinar. That's fine. So, but this will be worth attending.
Yeah.
All right.
Thank you all for attending, and thanks for listening in. I hope you guys got something out of this, and I'm looking forward to talking to you all next week on October 10th. The site is blocked.
For me. Maybe you've got it certainly worked for me.
It worked for me as well. I just pulled it up there.
All right.
Maybe some with lead pages for your
browser. Try a different browser or something. All right. I hope everybody has a great day.
Yeah, and Rocky, I guess the easiest way to sign up is through that link in the chat.
Yeah.
So that would be great, guys. I hope you all sign up so I can talk to you guys on Tuesday.
Rocky, you can sign up through me. I'll handle it.
Okay.
All right.
Ed, the plan is, I'm going to give you at least 6 months for $47 a month. If you're not seeing the value of $47 a month, we can talk. But generally, the idea is at $47 a month, this is deeply discounted. I expect that you guys are going to see a lot of value for 47, 97, or even multiples of that. But right now we'll start at 47 for 6 months and see how things go.
Yeah, we just don't want to be locked in if it turns out that it's a $100 or $200 service, but we want to give everybody an intro to try it out. You know what I mean?
Yeah.
We don't want to back ourselves into a price that's not efficient.
Yeah, and then a couple real quick, Gene. The first stuff will go out on Tuesday. That's when it's really starting. Lori, we're going to have both. I guess is the best way I can say that. I mean, a lot of it's going to be based on right now with vol as low as it is, buying outrights. But as you get that nuance, we'll get some advanced option trades out there as vol starts to come back up in some of these names, and where you get some benefits out of skew or the term structure. We can do some more stuff with diagonals and things, and that's some of the stuff I'll talk about more next Saturday as well. Yeah, and Mike, you can cancel anytime.
Yep.
Just that you get the first set, but you won't get $47 a month when you sign back up.
All right, folks. I hope everybody has a great day.
Yes. Have a wonderful evening, all, and good luck trading tomorrow.
We'll see you guys. We'll see you guys soon. Bye.
Have a great day.